About 4 minutes to the closing bell, and to help us get there, we've got Alicia Levine, BNY Mellon Chief Strategist, along with Loreen Gilbert, WealthWise Financial CEO. Welcome both to the stream. Let's start with you, Loreen, and we're going to get all kinds of data this week. One thing that we've already gotten is ISM Manufacturing Index for May. What should investors pay attention to in what we're seeing there?
Well, that is a great economic indicator to the strength of our economy right now, and that we are still in the early stages of this next cycle that we're in following the pandemic. So I think what it tells us is we're continuing to expand, continuing to grow, and that we can believe those numbers.
Alicia, taking a look at today's action, so the leaders I want to focus on, some of the reopening plays tied to the reopening of the economy, like airlines leading the way, meme stocks, AMC, a huge outperformer. We also have energy, the best performing sector today. Help us make sense of some of the action that we're seeing today and your big takeaway from today's moves.
Yeah, you know, the market's been really kind of stuck for the last 4 or 5 weeks, and it's been very frustrating. And you have certain days where cyclicals are outperforming and other days where tech is outperforming. Look, the message today really is that the reopening is continuing apace. There is an argument out there that we're mid-cycle, not early cycle. We still think we're pretty much early cycle. The data are getting much better, and we think earnings are going higher even still. If you look at what's happened with earnings in second, third, fourth quarter, analysts have not raised numbers at all despite the spectacular first quarter. So we think there's still a lot of juice to go. You know, the outperformance of the Russell is consistent with early recovery action, and that's what we're seeing here. You know, America is back. Memorial Day was the coming out party, and I think that's what the stocks are reflecting today. Look at the airlines. Look at, you know.
Yeah.
Yep.
But I hear everything you're saying. I think most of us agree with what you're saying. But has the market already priced in the earnings that we're going to be getting for, you know, future quarters, and that maybe the market's overvalued at this point?
So I don't think the market's overvalued. I think we go higher. I think it's definitely a case that we'll get some, you know, just some moments of tension over the summer. We think yields have paused here, consolidated, because we had a huge oversold condition coming into the quarter. I think that largely reverses in the third quarter as yields move higher. And with that, you're going to have some stress in the growth and tech trade as you move into the summer. And that's going to move the index because, as we know, tech is 35% of the S&P index. But overall, you might have some consolidation, but we do think that value and cyclicals are going to power through the rest of the year. That's where the earnings power is coming, and that's where the earnings beats are coming from.
All right, we've got roughly a minute 20 until we get to the closing bell. So let's take a pause with the guests, and let's take a look at where we are as we head into the close. The Dow right now still in positive territory, but it's pulling off of the highs of the session, up about 30 points. We've seen the S&P 500 fall slightly into negative territory. At this point, down almost 4 points, and the NASDAQ is off almost 17 points. A couple of things to keep an eye on, especially within the Dow, is the components. And we're paying attention to some of the big losers today. Johnson & Johnson off about 2.25%. And we saw the Supreme Court denied Johnson & Johnson's appeal to not have to pay the $2.1 billion settlement in the case regarding talcum powder, the 22 women who sued. So that case was upheld. They could face future liability from other lawsuits. Some of the winners on the Dow today, of course, Dow, Boeing, Goldman Sachs, all up more than 2%. In fact, Dow and Boeing are up almost 3%. And then one last thing, checking sectors. We have energy today up almost 4%. It's the big, strong performer when we take a look at sector action. And here's the closing bell.
And there goes the gavel. That marks the end of the first trading day of June, and we're looking at a mixed picture with settling well off the highs of the day. The S&P and the NASDAQ closing in negative territory. You can see the NASDAQ down just around 0.1%. The S&P off almost 0.1% here, so some selling action into the close. The Dow holding on to gains, but up just 46 points. Adam was going through the biggest winners there. Boeing, by far the biggest winner in the Dow, along with the Dow Inc. Those two stocks up almost 3%. Also, Goldman outperforming. Chevron getting a big boost today, up just over 2.5%. And of course, that boost comes as crude gains. We saw crude cross above $70 a barrel, selling just above $67 a barrel. That was enough for energy to lead the way, along with real estate and materials. We want to bring back in Alicia Levine and Loreen Gilbert, who are here to help break down the action that we saw not only today, but what we can expect going forward. And Loreen, if you're looking to put money to work in this type of environment, I think a lot of investors are trying to figure out exactly where we are in this reopening trade. I guess, what's your view just on where we stand in this recovery and where you're seeing some opportunity today?
Right. Well, what I would say is we've had such a run up since the lows of the pandemic that now I think we're going to see a summer that's a bumpy ride. And it's an opportunity for investors to go in as we see declines. And because we do expect that we're in a bull market run that's going to continue. So then we know that inflation may not be transitory, it may be more sustained. And with that, investors focusing on those areas that should do well in more of an inflationary environment, not a runaway inflation, but more inflation than we've seen in the past decade. So keeping that in mind for investors. And if we look at what was said earlier, I think I would agree on the cyclical, the value side, the small cap side, that we expect to continue to do well and that have been winners so far this year. So I would say we're probably going to end the year higher, but expect a little bit of bumpiness in the summer.
Alicia, when we talk about inflation, you provided a chart that shows a contradiction in what we're being told by the Federal Reserve and what we see in the actual data. Can you help us understand what that contradiction is so that we can make some decisions about what to do next?
Yeah, well, look, the forward inflation curve shows that the market is buying what the Fed is selling, which is that inflation will be higher in the short term and then go lower in the long term. So that's all okay. But the market is pricing in a first rate hike at the end of 2022 or the first quarter of 2023. And the Fed's out there saying not until the first quarter of 2024. So that's a big difference. That's a 4-quarter difference in where the market is expecting the first rate hike. So there could be some volatility in the bond market there. I'll say this, when we read the Fed minutes and there was some discussion about talking about tapering, there was relief in the market. I think the biggest fear here is the Fed is easy way too long and then winds up with an inflation problem and therefore has to overcorrect on the back end, giving us stagflation. So I think actually talk of taper and a pulling forward of when the Fed might tighten could actually be very healthy for the market, and I think the market would welcome it.
Alicia, it sounds like you think that the Fed is still being, even though it did make that, they said that they were talking about this, but I guess the message from the Fed you think is still a little bit too dovish at this point.
I think that the inflation reads are going to be hotter than expected and last longer than expected. Having said that, the data are still consistent with it being transitory, but at a higher rate at the end of it. And I think the Fed's forward guidance may have to be changed slightly to deal with that fact. The real issue here is inflation expectations. What happens with inflation expectations? Hotter and longer will unanchor them.
All right, Alicia, Loreen, let's bring you back into this. We're going to have Jared on standby for his final thought. But for investors who are trying to gauge everything that we're talking about, worried about the supply constraints that are perhaps making it longer for things to normalize, how do we incorporate how long we should use as our horizon for investing the potential for these supply chain bottlenecks?
Well, I think it is going to take a while for things to normalize, and we're seeing that. We've seen some pressure on the goods side, and I think we're also going to see inflationary numbers on the services side, and it's going to take a while for all those things to work out. And like I said, I do think we're going to see that continued inflation that's higher than we've had over the recent past. So with that, I think another thing for investors to think about is looking at international. When we look at international and increasing our international exposure, as we think that the dollar is on a continued downward trend, I think that's something that investors tend to be light in and something for investors to consider, especially when we look at Europe's probably about 6 months behind us in the recovery. If we look at what's happened in our markets in the recovery, look to Europe and possibly even, emerging market increased exposure. On the fixed income side, also looking at emerging market debt as another opportunity.
Alicia, taking a look at some of the movers today, the meme stocks I want to bring up again. We have AMC closing up just over 20%. The stock doubled last week. When you take a look at some of the enthusiasm, to say the least, that we've seen around some of these meme stock names, any fear there just about the potential risk that this could pose to the broader market?
Look, we saw it in January when after the huge run up in the meme stocks, we saw a huge degrossing across Wall Street, which led to a very unpleasant 4 or 5% downdraft in about 3 days as funds were forced to reduce exposure as a result of this. I think there's less of a risk here, but I do worry when prices become unmoored to what the reality is. And yes, the economy is reopening and AMC is the perfect reopening stock, but it has come fairly far. And so I think that if you are not in a play mood, but are in an investing move, it's not a bad time to take some profits here.
Loreen, when we talk about things normalizing, let's look at the housing market. I mean, crazy prices, people paying more. We had Robert Schiller on saying people are paying more than they should be paying for houses. But one of the things we don't talk about is that people are not bringing their houses to market. They're not selling. So that's impacting inventory, because where are they going to go? When does that dam break? Could we see normalization sooner rather than later as people finally say, I got to get it on the market?
Well, you've mentioned a great point that people aren't wanting to sell because they don't know where they're going to buy. And the other problem is that we don't have builders building to capacity. And with lumber prices continuing on the rise, a lot of them have pulled back on building. So we've got to have builders building. And of course, that's a longer term trend for housing to normalize. And then eventually people who are selling are oftentimes people who have to sell, people who are moving or that kind of consideration. But I would say that looking at real estate, when we talk about inflation as well, we expect that housing prices on average overall, of course, there are pockets that won't do as well, but overall, I think will continue to rise.
Alicia, the big event this week is going to be on Friday when we get that jobs report. We were talking to the Paycheck CEO, Marty Mucci, last hour, and he was talking to us about some of the trends that he's seeing in small businesses, the fact that small business owners simply can't find the workers. I'm curious just to get your view on how the market is viewing this, and I guess what the market expects for that print to be on Friday.
Well, it's a great question. We talk about it on our team all the time. I think part of what happened in the April jobs report released in early May is that there were some seasonality measurement issues. So that may help explain the enormous 800,000 miss on the top line jobs report. What we'll be looking at is wages, labor force participation, because that's actually going to tell us whether or not we really have a tighter labor market than we seem. I think that one labor report is not enough to tell us, but look, Wall Street's had 700,000 jobs added for Friday, 0.9% again. That would be problematic, and that would sort of suggest that have, close to 6 million people permanently unemployed who were working in February 2020. And that the Fed is closer to its inflation goals than it is to the employment goals. And that would be not great for markets.
Loreen and Alicia, hold on one second, because Dan Howley's standing by. We do have earnings from Zoom Video. They are trading down after market. What's going on? Dan, I think you might be muted.
I should. Can you hear me now?
We got you.
Okay. They had a beat on the top and bottom line. We have $956 million for revenue versus $910 million expected. And then on the earnings per share, we have $1.32 versus 99 cents. Importantly, looking forward into the second quarter, they beat estimates there as well. They're looking for between $1 to $1.14 to $1.15 on earnings per share versus 94 cents was what was originally expected. And then for revenue, we're looking at $984 million to $999 million. The expectation was for $941 million. So they beat there, but you can tell, obviously, the stock price off as much as 3 to 4% right now. I think going forward, the stock is really going to depend on the kind of customers that they're continuing to hold on on to, whether they can carry over those customers from companies that are 10 or more employees, as well as the ones that spend more than 100,000 for the trailing 12 months. Those are the ones that are really going to be important. The consumers who were using it for the pandemic didn't put much into the revenue at the end of the day. It comes down to those businesses. We'll see going forward into the Q3 and Q4 if they hold on there, and Zoom can count them as customers going forward. For now, though, looking like a beat for obviously Q1 and then for expectations for Q2.
All right, Dan Howley, thank you very much. And thank you, Loreen Gilbert, WealthWise Financial CEO, as well as Alicia Levine, BNY Mellon Chief Strategist.